Okay, we just want to welcome everyone to the Navigating the Ever-Changing Landscape of Import Tariffs and Trade webinar. We here at Missouri Enterprise are really excited to partner with the World Trade Center in St. Louis and bring you this expert presentation today. Our speaker has been helping businesses manage the legal and compliance aspects of international trade for many years. I'm Lindsay Loffridge, and I'm with Missouri Enterprise, and we're thrilled to have you with us today. For those of you who may not be super familiar with Missouri Enterprise, we're dedicated to supporting manufacturers across Missouri. We help them grow and thrive through different consulting services, workforce development, innovation, and different strategic solutions. Our mission is that we want to drive success and competitiveness for Missouri manufacturers, providing that expert guidance and resources every step of the way. We do have a few housekeeping rules to let you know a little bit about today. All participants are going to be muted for the duration of this presentation. But if you do have questions or you wish to ask any questions, please do so by using that question and answer button you can find just down at the bottom of your screen. We'll do the best to keep those going and make sure we're reading those as the presentation goes, but we'll make sure and answer those at the end of the presentation today. So the slides and the recording of this presentation will also be available in a few days after this webinar is completed, and you can find those on the Missouri Enterprises YouTube channel. So now it's my great pleasure to introduce you all to Susan Spitz, the Manager of International Business Development for the World Trade Center St. Louis. Susan is going to introduce our speaker today, so over to you, Susan. Thank you.
Thank you very much, Lindsay. We are also excited to bring this expert presentation to you all. And for those of you who don't know that there is a World Trade Center in St. Louis, or if you don't know what we do, which I didn't before I started working there, but we are part of the World Trade Center Association that's around the world. And there is another World Trade Center also in Kansas City. And we both use sort of an economic development model in the work that we do. So essentially, we're the International Department of Economic Development for the state of Missouri. We're under the St. Louis Economic Development Partnership, and we've got three main areas of focus. So trade, which is what we're talking about today, investment, and people. On the trade side, we focus on increasing exports from Missouri companies to the rest of the world through all kinds of research and resources, such as this kind of webinar, informational webinar. We also support foreign direct investment in the region. We want to make sure that the existing foreign-owned businesses have what they need to stay here and to grow. And then on the people side, we actually oversee our 16 sister cities with the St. Louis region. And then we operate the St. Louis Mosaic Project, whose goal is to grow our foreign-born work-authorized population, because this is a segment of the population that contributes greatly to our regional economy. And we're happy to say that the St. Louis Mosaic Project has actually helped to make St. Louis the fastest growing major metro area in the nation for a foreign population increase, which actually offsets our net population loss that's happening right now in St. Louis. So it's very exciting. The World Trade Center works closely with the state of Missouri's International Trade and Investment Office, which has 14 offices around the world to help Missouri companies to grow internationally. We also work with the St. Louis office of the U.S. Commercial Service, which works with all of the embassies and consulates around the world. Yes, and even in this time of tariffs and trade wars, there is still a lot of trade going on. So there are resources that include financing and insurance vehicles to protect your sales activity, cover some of your trade show expenses, even assist with website translation. And we do a lot of educational events. Yesterday, we had something on doing business in India. So consider joining our membership or adding your name to our email list, in which you will find you will receive our event invitations on the main part of our web page, or main landing page of our website. If you go to the lower right side, you can sign up to get on our email list. And the upcoming event that we have on May 15th is going to be on foreign trade zones, FTZs, and that is a potential way to mitigate or reduce the impact of tariffs. So if anybody's interested in that, I'm sure Lindsay will be sending out the invitation to that once it is posted. And that's enough about World Trade Center. What we really want to do is hear from Jennifer. So let me introduce Jennifer Schwessig to you. She is a partner at the law firm of Armstrong Teasdale in St. Louis. leading the international practice there at Armstrong Teasdale, and she also serves as Assistant General Counsel. And she advises domestic and international clients on cross-border transactions, on foreign direct investment, and international corporate compliance. Her work includes everything from entity formation, mergers and acquisitions, joint ventures, international franchising. She's particularly experienced in drafting international disclosure documents and agreements. She also counsels clients on U.S. export and import regulations, sanctions, the Foreign Corrupt Practices Act, and customs compliance. She frequently provides compliance training for multinational companies, and that's kind of what she's doing for us today. So we're very thrilled to get her when she has a moment free, which I know is tough these days. So Jennifer holds an LLM in International and Comparative Law from Georgetown University, a Juris Doctor from Washington University, and a BA in History from Kenyon College. And throughout her career, she's received a lot of acclaim, including being recognized by the St. Louis Business Journal as one of St. Louis's 40 under 40 a few years ago. And she is a member of the American Bar Association, the International Section, and the American Society of International Law. So we are thrilled to have you present to us today, Jennifer. So thank you for your information and presentation. You may take it away and bring up your slides. Thank you.
Okay, I'm going to bring up my slides, which hopefully everybody is looking at now. Okay, welcome. We're going to today talk about tariffs. And I know people have been speaking about tariffs for quite some time now, at least in the last few months. And this is one of the most ever-changing areas of law that I have been involved in my 25 years of practicing law. So particularly in the last few months, there's a lot of talk about tariffs, which was quiet in the past, but is now really energized and moving forward. So including some updates I've made to this presentation last night for some of the auto parts changes that happened to 232. So there's a lot going on. What I tell you this morning might not be the case this afternoon, but I'm going to try to cover some really specific things today, and then some more general things that can apply when you're looking at how tariffs apply overall. So I'm going to talk a little bit about the tariff increases and the changes and what they all mean, and some of the legislation and what's going on in terms of these tariffs, and then talk really about kind of the specifics on it. How do we assess tariffs? How are tariffs applied, which are really duties or taxes on the import of goods? And so there is going to be a focus on origin, classification, valuation, and then probably what many want to hear about. I'll sort of wrap things up with duty mitigation and why we care about all of this, because there's high penalties and risks in this area. So moving forward, the main basis for a lot of these tariffs, and tariffs aren't new. We've been having tariffs in the United States since the beginning of our country's existence. But these large tariffs and tariffs targeting different countries are somewhat new. But the basis of all of this has usually been a series of trade laws we have in place that protect the United States in times when we need protecting from unfair trade. The basis for all of this, though, if you really want to look and see where all these tariffs coming from and where are we going in this particular administration, is to really look at the America First trade policy, which is a memorandum issued by Trump that pretty much outlines everything that this administration hopes to do in terms of trade. And that was something that came out on January 20th, but the report that they asked, the president asked for a report to be issued studying all these different areas. That report has come out more recently. And so this is kind of our roadmap to where we're going. And the focus in this America First trade policy is unfair and unbalanced trade, our existing trade agreements like USMCA. We're looking at all those things again. Currency manipulation. So there's actually been discussions of an external revenue department, one where we can deal with if we think other currencies are unfair. certain discriminatory tax policies. We have lots of tax treaties that help us not get double taxed when we're doing business overseas. We're relooking at all of our trade remedy law changes, the anti-dumping duties, the countervailing duties, Section 301, which many may be familiar with, which targeted China with the original duties that we're talking about, the 25%. And then 232, which has been around for a while. The de minimis exemption, you might be hearing a lot about de minimis. Those are small shipments that come in and don't require formal entries or any duties paid. A lot of this is targeting China and Hong Kong for that matter too, with various issues that this government sees with China, fentanyl trade, stealing of IP, naming China one of America's adversaries, and considering whether we want to continue permanent normal trade relations, which is what we have with almost all countries, with the exception of a few countries that are like Iran and Syria, Cuba, places where we've stopped all kind of trade relations. We're also going to start looking at export controls, and what's really new in a lot of this is we have inbound investment restrictions, but we might start also looking at outbound investment. So are there restrictions on investments into China or other countries? So this America First trade policy, it doesn't announce or implement new tariffs. It's just, it's asked the government, various government agencies to look more thoroughly into these different areas that are named. So that investigation, which was concluded on April 1st, is really focused a lot on unfair and unbalanced trade. So they're targeting countries with significant annual trade deficits in goods, and then country-specific tariffs, which we've just seen with the reciprocal tariffs that were wound back. With the exception of China, the reciprocal tariffs are remaining, and what we're seeing with the global tariff, which is the 10%, which has not been wound back at all. So we're also looking at our free trade agreements, starting with USMCA. And we have different trade authorities. A lot of this is being done through executive order, but we have a lot of trade remedy actions in place. These series of numbers that we call out, like 301, 232, those are sections of trade acts that we've had in place from 1962, 1974, various different trade acts that we have in place. And then there's some really new laws that we're using to implement tariffs that we've never used before. So tariffs under specific legal authorities, there's a new one, which I'm going to talk about, which is the IEEPA, the International Emergency Economic Powers Act. And then the existing ones, which we implement with EOs. And then we've got tariffs using these same sections that are specifically targeting China and no other countries. So let's start with the International Emergency Economic Powers Act, which is a mouthful, the IEEPA. That is what we are seeing almost all of these new tariffs come under, except for the aluminum, automobile parts, and steel tariffs, which are under our existing 232. This is not a traditional tariff act like many of our other tariffs act. This is actually something we use to implement sanctions and have always used it to implement sanctions in the past. For example, the Russian sanctions this was before we implemented the Russian harmful activity sanctions. This was the headlining legislation that allowed us to do that. And so it's very unusual that we're using this for tariffs. And the reason I bring this up is because it's not really designed as a tariff legislation, meaning it doesn't have the typical things in it that we like to see about exclusions and drawback and what happens when we bring things into foreign trade zones. It's not built for that. So the executive orders are having to outline things that are typically when we use trade acts in those, which makes this particularly challenging. It's also a law that basically says if there's any unusual or extraordinary threat that happens outside the United States that impacts us inside the United States, it's really a national security law, we can implement it. So it makes tons of sense in the sanctions realm, but not so much unless we're saying that the implementation of tariffs is a national emergency and a matter of national security. And there are a lot of lawsuits challenging the fact that this law really can't be used in this way. So we'll have to see how they work through the courts. But they've also used this as a national emergency for fentanyl. We saw this with regard to Mexico, Canada, and China, fentanyl flows. And then more recently, trade deficits. We've seen this implemented. So what's going on right now? I'm going to kind of walk through these tariffs change sometimes more than 3 times in a day. I've had a day where things have been wound back. We've seen Mexico go back and forth. We've seen Canada go back and forth. China, we've pretty consistently stayed hostile toward in all of this by steadily increasing. And where we are with China is at 155%, which is a combination of the 125% reciprocal tariff plus 2 10% tariffs that were implemented under the fentanyl, and then the other 25% being more related to the trade imbalance, the reciprocal tariff. These tariffs are in addition to the Section 301 duties that were already in place and targeting almost every product, although there were exclusions from China in a variety of tranches. And we'll talk in more detail about these, but there are some exceptions under 232 on the 125%, where if the 232 applies, then the 125 doesn't apply. So you end up with a 55% amount. So, and then China has no de minimis now either, meaning 800 or less. You've still got to do formal clearances for this. So this is all these small shipments coming through Amazon or other things, more consumer based. In Mexico, we saw 25% implemented, but then we saw it suspended. Then we saw nothing on reciprocal tariffs for Mexico after when we saw all the other countries before they were repealed. So right now we're right back to USMCA on Mexico. So if your good is qualifying under USMCA, then you don't have any duty. If it is not qualifying, you're subject to 25% plus whatever the underlying duty would be, as if it were coming in from a non-free trade agreement. Canada is very similar. We saw the suspension there. We have seen global tariffs get implemented, and that was not repealed when most of the reciprocal tariffs were repealed. So we do have 10% on anything coming from any other country, with the exception of Mexico and Canada. And of course, China has a much higher percentage. The second part of that executive order was the reciprocal tariff that hit approximately 57 countries, and the tariffs ranged from 11 to 50%. That was suspended to July 9th, except China. And that was also based on imbalances. So all the countries right now are trying to negotiate to see what their reciprocal rate would be if this all goes back in place. Again, on the reciprocal tariff for China, that's the only one that remains right now, other than the global tariff. And there are certain exceptions, as I said, for 232. There's exceptions on China for Annex 2 for certain goods that are listed on that Annex 2. Some things that we're in short supply of, like copper, pharmaceuticals, semiconductors. But we're launching investigations into those to determine if those should or should not be excluded. Other things that are excluded, and again, this is China, are humanitarian items, certain things that are Canada and Mexico, USMCA qualifying, de minimis now, except China. And there's also a new rule in that if there are goods with US content, at least 20% of US content, then it's only the non-US portion of the value. Also, in order to qualify as US content, it has to be entirely produced or substantially transformed in the US. So that takes us kind of through the EEPA tariffs, which are the big ones that we've seen recently, but they're not the only ones. We have another section where tariffs are going on under here, which is 232 of the Trade Expansion Act. That's why we call it 232. That has been in place forever. There's been steel and aluminum, but much lower rates are at 10%. That's been up to 25% on steel and aluminum products. The interesting thing is there's a much broader, and that's been in place since 2018, but there's a much broader understanding of what's a derivative. Before, we might have just looked at plain steel products, for example, sheets of steel, even nails, but not these really specialized products that are secondary products to them. And now they're looking at a lot more derivatives, and those are derivatives that are in HTS code chapter 73 and chapter 76. Same with aluminum derivatives. Those were added on February 10th. On April 4th, there was the beer can, 25%. So it's important here to look very closely at, even if you don't have primary steel or aluminum, you might have a derivative that's subject to this. Again, this only applies to the declared value of the aluminum or steel content in the derivative article, not the entire value of that article. We also suspended a lot of we exited out of a lot of our agreements suspending tariffs for a number of countries. We had quite a few countries, Brazil, I think, included in that, where we had suspended tariffs on aluminum and steel. In addition to aluminum steel, the one thing that's been raising a lot of ire recently is the passenger cars, light trucks, and certain parts, 25%. On April 3rd, the cars and trucks went into play. We're still waiting on May 3rd for all the parts to come in, and I think the parts has been quite a big concern recently. The parts that are covered are engine and engine parts, transmission, powertrain parts. It's a wide variety, electronic components, etc. For USMCA, US content's exempted, but part of the concern here is there's no drawback, and everything that enters, which I'll explain later, into a foreign trade zone comes in as special privilege status, meaning when whatever the duties were at the time it entered the foreign trade zone is what the duties are going to be when you pull it out, which is very different than in the past, but very similar to 301. So this is an update as of last night. We got an executive order trying to unwind part of these automobile part tariffs, or it doesn't really unwind them at all. It actually just, and just having read this pretty briefly, it's actually just trying to mitigate for encouraging assembly in the US. So it's offsetting a portion of the tariffs for automobile parts if they're used in US assembled vehicles. And there's certain percentages that go along with this. So the first year there's one on, starting April 25th. It's going April to April of 26, and then the rate goes down, the savings rate for the year 26. So basically a duty's owed when there's a 25% duty is applied to 15% of the value of a US assembled automobile, for example, in year one, and then 10% in year two. So a car that's built in the US that has 85% US or USMCA content, then there's no tariffs for the first year. But if that car is 50%, then there's 35% on the imported parts. So just importing the parts and not assembling them, it won't do you a lot of good, but if you are actually the assembler, it may help. All the other automobile imports will be subject to the 25%. So that's the rollback we've seen so far. I don't know if more are coming. There's a bunch of new investigations into the things that are excluded, like heavy duty trucks, semiconductors, pharmaceuticals, critical minerals. We're looking at lithium and cobalt for batteries, copper, timber, and lumber. So there's new investigations that could result in new 232 duties. In addition to the ones that we're talking about that are really in the news and have been in the news for a while, which is the IEEPA and the 232. are the existing duties that we've seen for years, that were implemented during the first Trump administration and that were maintained by the Biden administration, for Section 301. Now, there were exclusions where certain products weren't excluded, but basically, if your product falls into tiers 1 through 3, it's a 25% duty, and tier 4A, it's a 14.5% duty. That's been in play for a long time, as I said, and that's all China. All the 301 duties right now are applied to China, although America First trade policy has said we're going to look at whether we are going to apply Section 301 duties. Part of the difference between 301 and 232 is the rapid speed in which these things can be implemented without being studied. For IEEPA, they can implement a tariff tomorrow. For 232 and 301, they've had to somewhat follow the process that the trade acts require, which is an investigation into some of this. There are other areas of the tariff acts that can be used in addition, which is Section 201, which is our domestic industry is injured or threatened. We've got IP protections, so for counterfeit products and contraband drugs under Section 337. I think part of the challenge, though, is there's traditionally been exclusions. For example, I have a client that needs magnesite to make refractory bricks. We don't have magnesite that we can mine here, or we might not have products that are available here that we need to produce certain items. And so there's always been an exclusion process to exclude those out and keep them duty-free. In a lot of these executive orders and other things, this administration has dictated that they intend to wind back the process for applying for exclusions and other benefits we have to show that we can't get access to something, or it might be short supply here. In addition to the tariffs that we were talking about under these acts, there's always another area that's been, since you can see it's the Trade Act of 1930, so we've always had anti-dumping and countervailing duty investigations and duties. And so you can see certain countries might have 100% duty on something or 150%. But that usually requires a year-long investigation and a finding that there's a material injury or threat of material injury to a U.S. industry. Lots of information is provided. You may have been asked as a downstream supplier or a downstream consumer to participate in any of these, or gotten questionnaires. Those actions are really specific to products and certain manufacturers. So in terms of those, are the reason I bring these up is you could have an overlap from China. Extruded aluminum is one, for example, where I have a client who has who's bringing in extruded aluminum products that might fall under multiple things. 232, they might be subject to additional dumping duties. Some of these duties on some things coming from China can move upwards of 200% duty. And that's all in addition to whatever base duty the HTS has in it. So keeping in mind that whole tariff background and scenario and all the facts that these are being implemented, import compliance has become tenfold the risk that it has been in the past, although it's always been in a risk. Okay. I have clients who've had to pay penalties and fines. I've had clients who've had to go back and pay back duties, millions of dollars. I've had clients that this has bankrupt their company because they misdeclared something entering in the country at a lower duty than it was, or they misvalued it, or they said it was from one country when it was from another, and customs stopped a shipment, which they do very frequently, and they ask them questions about it. So, and there's usually ways you can proactively resolve that way before customs gets formally involved, which I'll talk about. But, the risk here is really high. The importer has a duty of care. They must use the reasonable care standard when you're applying, and I'll talk about what that means. It's when you're looking at classification, what's reasonable care. It's not just picking the one with the higher duty versus the lower duty because two things might apply. So the key to identifying these risks and mitigating them, particularly when your duty loss could be so much higher, is looking at the source in the customs contact. So that's what we're going to kind of do. What's the right way to classify your goods, and figure all these things out as you go. The biggest risks areas are you've declared the wrong, as I said before, the wrong origin, classification, or valuation. There's also inconsistencies between trade regulations and free trade agreements. I give the example of USMCA. I've had a client that's brought in goods from China, or raw materials and parts from China that they're further manufacturing in Mexico, and then shipping on to the United States. You declare this as qualifying USMCA origin, but the 301 duties have a different origin test, for example, than USMCA might have. And so you end up in a position where it might be Chinese origin for 301 tariffs, but Mexico for USMCA. And that happens a lot with our free trade agreements and these new trade laws that are new applications of tariffs under various trade laws that are being put in place. There's also risk because there's less exemptions and exclusions. There's risks if you're in a long-term or other supply agreement, because you suddenly, what does that agreement say about how things are being shipped to you? Who's responsible for paying duties? How are you able to pass those duties on to your customers? Or are you able to do that? There's also a risk of retaliatory tariffs on the other side. New uses of laws that even us who've been studying this for years aren't quite sure of the outcome on. And something I've looked at pretty recently is there are a number of states, there's 4 states now that I'm aware of, Missouri isn't one of them, that have been passing these consumer protection laws relating to tariff, where if you have a consumer purchasing something, you can't just simply add the word tariff surcharge and put a charge without showing a real basis for that tariff. And then there's also, in most states and federal laws, general consumer protection laws that say you have to be transparent about that. And on top of all of this, there's a lot of federal personnel are leaving, resigning, being removed. These agencies don't have time, particularly customs, to implement even these new duties that are coming in with their system with 1 day's notice or 1 week's notice. So you might not actually be charged the duties initially, but I've told all our clients, reserve for these duties because they will come back and they will add them when their systems catch up. So in order to understand how to even mitigate duties or not be subject to any penalties, you have to understand how duties are assessed. And they're assessed on 3 bases. How is the import classified? What's the correct HTS or HTS US code? And then how is it valued? What is it worth? Have you chosen the right value? And then what is the origin? So I'm going to walk through a little bit how to do that. So on tariff classification, everybody who's a member of the World Trade Organization, World Customs Organization, which is almost every country, we all harmonize our tariffs up to 6 digits. And then each country goes beyond the 6 digits to say specifically what it is to align it with their taxing system or tariff system. So that is where the product belongs, and there's a duty attached to each classification. Various chapters and sections dealing separately in broad categories. All of tariffs are determined generally on 2 bases, either ad valorem or per kilo or by a weight. But for those where it's ad valorem, which is a percentage of value, then figuring out all of these is really important to make that determination. I often get people who approach who say, okay, my manufacturer gave me a tariff code, but that manufacturer may only have given you a code that's applicable in their country. It might not be applicable in yours, or only up to 60. You can't solely rely on what they're giving you. If you're the importer of record in the United States, meaning you're the responsible party, you've posted the bond, you're going to be liable even if you relied on your supplier to classify this correctly. And your broker may not be looking at this. They may be taking something off of your commercial invoice or something. They may not be double checking unless you specifically ask them to look at it and help you classify. Generally, the specific prevails over the general, meaning if there's a more specific classification, it belongs in the more specific classification, you know, because oftentimes we see things that can fit in multiple different classifications, but you go to the specific and you go to the general notes that are the chapter notes that tell you what this can and cannot apply to. It's the classification does not go by, I found one in a lower duty, so I'm picking that one over the higher duty. Although that is often the motivation, but we have to make sure that there's a legitimate basis, because if there's a difference and you've put it in the wrong duty, you're going to owe the difference plus penalties and interest if customs doesn't agree with you. There's also different legal notes and general rules of interpretation that give more information. There's precedent. The customs has a cross system. It's a rulings database where they've looked at similar products and they've decided how those should be classified. And while those are only binding on the person who submitted it, they also actually push customs to say this is reasonable care. If we've ruled on this numerous times in the past, then this is where it belongs. And then finally, there are a number of these that are really subject to heavy debate in the Court of International Trade, which is where you take appeals from customs and then on from the Court of International Trade to the Federal Circuit. So I've given an example of HTS code section, and you always look at the chapter is always the first two numbers. So this would be chapter 76. And then these are the headings, which are usually 4 digits, and they give you everything under that heading must fall under there. I've given this aluminum as an example. And then there are subheadings under it, and you have to take it down. And this is where we go to, you know, the full digit. This is the last, all these subheadings under it when you take a look. And if it doesn't fit in any of those, it becomes other in certain cases. So it's from chapter to heading to subheading to subheading, and you're down here looking at the most specific thing. You'll also see little, which you can click on them here. These are telling you that this might be subject to anti-dumping duties, and this is going to be subject to 301 or some other IEP or other special duties that may apply, which will show up under chapter 9903. So a lot of times you'll get a second classification, which is this chapter 99, which is really telling customs how to apply the different duties. So there's the general rate that in these columns that apply to all WTO members. Then there's the free trade agreement rates, and then non-preferential rates. These are the different columns. So you'll see these are our free trade agreement countries. This is everybody who's a member, who's permanent normal trade relations. And this is the other group, the few countries that aren't. So it's usually this rate apply unless you've got a free trade agreement. And as I said, there's 3 types of duties: ad valorem, meaning a percentage; specific, meaning it's a specific amount of weight, 10 cents per pound; or compound. Sometimes we have a combination of 5% duty plus 10 cents per pound. And as I said, the additional duties, they're now showing up in this chapter 9903. So you've got to find the corresponding 9903, which your broker will enter. Valuation is another very tricky area of the customs. I would say it's even more difficult to do valuation as opposed to, and people don't usually pay attention to valuation in the same way. So since duty is determined as a percentage of the value, it's also necessary to determine the value to determine the actual duty. If it's $10 and you know, it's a percentage of that, that's what your duty is. So there's basically 5 methods of determining value. The first one, and the one we should always be using, is transaction value. it's a buyer in the US, it's what you paid, it's what you've been invoiced for those goods. So typically that's the price paid or payable. But there are certain cases where customs says the price paid or payable doesn't actually reflect the transaction, because there might be other factors that are weighing in that distort the price paid. Like it was worth more, but you paid less. When the parties are not related, we're going to assume generally what they're selling it to you for is what it's worth. But when the parties are related, customs basically says it's not. If you're selling between subsidiaries overseas in the US, they have a completely, they're telling you, you normally can't use transaction value because you could manipulate the price. So you've got to apply a series of tests like the circumstances of the sale to make sure that this is valued correctly. And merely having an IRS transfer price is not sufficient in customs eyes. So if you can't use transaction value for whatever reason, because you've got related parties, or as I'll talk about later, there's other values in here that might not reflect the value, you typically have to use transaction value of similar or identical merchandise, which you don't often have if you're the one selling it, or use deductive value, which is a formula where you take the resale price in the US and then deduct out certain profit and other expenses. You could do a computed value, which is the sum of materials, all the costs. It's basically the cost to manufacture it. And if you can't do any of those, you can ask customs for a fallback method, meaning I can do deductive value, but I can't do a resale in 90 days or something like that. So customs says value also includes additional items. And this is where we get into needing to use some of these other valuation methods. It includes something called an assist. Like, for example, if we used engineering that was part of that and we didn't include that in the cost, or we provided our supplier in China the tooling to make a certain product, and that way that product is much cheaper now because we didn't have to pay for the tooling, then customs says, no, you got to go back and add in that tooling. It's an assist. Anything you gave the supplier, the buyer provided to the supplier free of charge is an assist. Also, certain packing costs need to be included, but not all, but certain of them. Commissions, certain selling included, selling commissions versus buying commissions, which you've got a middleman. Certain royalties that you're paying or license fees on a product, certain proceeds of a subsequent resale if it accrues to the seller. So like, there's a lot of opportunity here for manipulation. A lot of our clients are saying, oh, what if I just make the value less? Or they invoice me this amount, or their supplier in China is asking to do that, invoice you in this amount, but then we'll actually clear it for you in customs under that amount. So there's a lot of fraud opportunities in the value area that can come back and really bite you. One area I've really seen is that a supplier, particularly in China, saying, I'll supply this to you, deliver duty paid, so I'm clearing everything. We know they're likely to put down something that may be incorrect there. But if they're using your importer of record number, which you should never let someone use your importer of record number, then you may be liable and you may not see that they're doing a different value. There are charges that are excluded from the customs value, such as international freight, and other charges incidental to international shipment. But you have to pay attention because there's really specific requirements as whether foreign inland and domestic inland freight are included in those. There's specific requirements. Generally, they're excluded unless you can prove certain things. And then in addition to duties, you also have to pay the merchandise processing fee, which is, has a max out. You have 600 something right now. And a minimum on all shipments, but they're also part of the value. And then the harbor maintenance fees. So even if the product doesn't have a duty, these fees are also a percentage of the value. The last kind of big area of risk is customs origin. Where is something coming from? It's not the place of shipment. It is the place where the good was manufactured or otherwise substantially transformed in that particular country. For most tests, there may be different tests for free trade agreements. So I've had a lot of people come and say, I'm just going to ship this from Vietnam instead of China. So now it's Vietnamese. It is not, unless enough manufacturing was done in Vietnam to make it Vietnamese. And even minor manufacturing processes, a lot of times don't count. And I have a lot of examples of things that we would think would be transforming something that are not. So for all of these things other than a free trade agreement, the test is substantial transformation, which means it's a change in name, character, and use of the good in that particular country, that the item that was changed gives it its essential character. And there's lots and lots of customs rulings on, for example, if I just bring some fabric in a country and then I cut it down, is that substantial transformation? No. I brought lithium ion battery cells and I aligned them all together in a box with a motherboard. Is that substantial transformation? No, says customs. So sometimes they say yes, and sometimes they say no, but this is something to pay attention if you're manufacturing if you're getting something that's manufactured in more than one country. When there's a free trade agreement, there's specific rules under that free trade agreement, like USMCA, which are multilateral free trade agreements, and bilateral, which I have listed all our countries here where we have bilateral free trade agreements. Usually in those trade agreements, there's rules that are a tariff shift. It has to shift from one heading to another, or it has to have so much regional value content, which can be very, different percentage of what the regional value needs to be, different tests. Sometimes it's a combination of a tariff shift and a regional value content test. So you have to look to the rules of origin in the free trade agreement. And just because it qualifies under the free trade agreement doesn't mean you'd be excluded from other duties. You may still be subject to all of the other duties if the origin test is different under that agreement. So probably the thing that most people want to hear about today a little bit more is what kind of duty mitigation opportunities are there? Are we just stuck with these duties, or is there anything we can do? Well, the big picture is yes, you are stuck with them, but there are deferral techniques, and then there are some things just to exclude your product. The first place I tell every one of our clients to start is, do we have value right? Perhaps we're overvaluing it. Maybe, do we have the origin right? And can we manufacture somewhere else? Can we supply somewhere else? And is the classification right? Because some of these classifications may have exclusions, or they might have like a lower duty rate. So in all of these things, if the underlying duty was 5%, and then we put on another 25 and another 125, that 5% doesn't go away. You still it's the underlying duty, and these all begin to stack on top of each other. So looking at those is important. But there's also some more specific things that you can think and look at as you go through. One of them is first sale. If for some reason the good that you're getting or your import, the supplier, there's a middleman involved in sourcing these goods, and that middleman had a markup, you can use in some cases, the original value of the goods. So if my middleman marked it up 10%, and it's, I can use the first value instead of the 10% markup if I can show that it's a bona fide sale, that it was destined for the United States, and that I've got clear documentation that that first sale price was cheaper. So that's one way to start reducing duties. Another way, and I know there's going to be a talk on this, which I too am interested in hearing about, foreign trade zones and bonded facilities. These are really duty deferral methods. So for a bonded facility, there's a limited amount of time that you can bring something in. You can put it in a bonded facility and you don't pay duties until you withdraw it from the bonded facility. So it's not considered entering the customs territory of the United States. There, you can only do minor activities in a bonded warehouse. You can't do manufacture. You might be able to do pick and pack, certain packaging, certain minor manufacturing processes. But full manufacturing processes have to occur in a foreign trade zone, which is very much similar in that, you know, you can leave goods into there. And if you never bring them into the United States, you're just doing some manufacturing here, you can export them out of the country without ever paying any duty on it while it's in the foreign trade zone. If it enters the US territory, a customs territory after leaving the foreign trade zone, then you pay the duty. The interesting thing about all of these executive orders is that all the goods entering these zones are entering under privileged foreign status, which means the duty rate has to be the duty rate at the time it entered the foreign trade zone. That's true of 301 and all of these new duties. But in previous things, if you do transform it into a different product, it's whatever that product is. If it's a different HTS code, you may be able to enter it in under that new HTS code at a different duty rate. But whatever that HTS code was subject to, these special duties will remain. There's also duty drawback for products that are brought into the United States and destroyed or otherwise returned and leave out of the United States. So you did certain manufacturing in the US and then you re-exported them. You never used it or you returned the merchandise. You can apply to participate in the duty drawback program, in which case 99% of the duties are drawn back. There's been a lot of debate under these various different executive orders as to whether drawback applies to some of these things. And Customs has said it does in some and not in others. So, or has not been clear. You can, and in the past, the items I have highlighted in red are things that were there but are going away or in jeopardy. You can say, I can't get my product here in the United States. There's a lot less ability to apply for that. And we're not sure yet if that's happening under 232 now. There's temporary importation under bond, meaning I'm just bringing it in for show purposes, or I'm bringing it in temporarily and then I'm re-exporting it. You might not have to pay duty while it's here. You post a bond. There's various different requirements and different options under temporary import under bond. There used to be de minimis when it was valued below 800, but now even above 800, we're requiring formal entries, and from China below 800 formal entries. So duties are owed and you have to make a formal entry process. There's another area called 9802, which is again a chapter in the tariff code where it covers articles that have been exported for repair, your further processing, like you sending something down to Mexico, doing further processing, and then returning it to the United States. We only assess duties on the value of the upgrade or repairs or processing that occurred in Mexico. So another thing is under this IEEPA 155% on China, there actually is an odd opportunity to mitigate this down if your stuff fell under any of the 232 tariffs, meaning it was an auto part or aluminum and steel or derivative or an automobile. That rate is actually 55%. So oddly, I have a number of clients trying to say I'd much rather have this under the aluminum tariffs than have to deal with the 155%, because they've said only if 232 applies, it's the tariffs on 232, not also the 155. And then there's also US content, which is in the new the new global and reciprocal tariffs section. It says if you have 20% US content and it's the same substantial transformation test, you can exclude that content from the value, but they're going to be auditing heavily on that. So these are some of the duty mitigation opportunities that you may have as we go through, with the red ones being the ones that are probably a little bit more in jeopardy than they were in the past. So where are the different, so there are some additional risk areas all of this raised, which I brought up some of them. For example, the change to DDP, all of a sudden, are we bringing in things under your IOR, or is it your supplier's IOR? Are there buying and selling commissions in it? Is it manufactured in one country and completed in another? Are you sure you've classified value? You got the origin right? Are there related parties involved in the transactions? Are there assists, things that you might be missing that you need to add in? Are there additional anti-dumping duties on these things? Are additional payments made to your supplier, like price adjustments and those kind of things? So all of this sums up to the fact that the opportunities for fraud are increasing. And everybody doesn't want to pay these high duties, so they're changing values, changing origins, doing things. What's the risk? I'm constantly asked the question, how is customs going to catch me, and what's the risk if they do? What if I value it wrong? How are they going to know I valued it wrong? And I say the same thing. I could probably speed down the road a lot, and maybe there's no cop car to stop me, but maybe there is. And I'll tell you the ways I'm seeing it. Customs has now they're overloaded right now, but they have a pretty sophisticated system that they've upgraded to in the last few years, where they are comparing if you've suddenly changed the value of a similar import, you've changed the classification suddenly. They have a system that alerts to all of that if you've been importing. They also stop shipments. I've also had clients who said, my competitor is doing this wrong and I'm doing it right, so they're paying this and that. And so we've had competitors reporting people. Customs will often reach out with a CF-28 or a CF-29, a request for information, and they're asking you to give more information. And when you go to give that more information, it's clear to you, uh-oh, I'm not going to be able to show them what they need to see. So in those cases, I'm saying, you've got, not only do you have to keep clear records on anything, because they could ask you to produce extensive records showing origin, all the people working in a particular factory. I've had them ask really onerous requests on all of this. And ask for all of that information. If you just respond to them without checking with your broker or someone else, you may have put yourself into a situation where you've disclosed to them that you've done something wrong. The penalties are pretty significant in all of this, and that, they can be if it's pure fraud, 5 to 8 times a total duty loss. If it's gross negligence or negligence, a little less, but we're looking at, double the value of shipments, or even 4 times the value of the shipments in certain cases. So that becomes really critical. If you find something wrong before customs finds something wrong, meaning before they've gone past the CF-29 phase, you can actually do something called a prior disclosure, which you can tell them, I did all of this wrong, and I'm just going to pay the back duties and the interest on the back duties, and that's it, to avoid penalties. But you can only do that if you discover it before the government discovers it. So with that, I'm going to wrap up and end things. And
we're at 11 o'clock. Thank you very much. And I knew we should have made this a longer webinar, but I think this is excellent information. We've got a number of questions. We'll do them in timing, in order of when they were received. The first couple of ones all have to do with USMCA, and you may have gotten to some of these later on in the presentation, Jennifer, but there's a question about, when does the exemption for Canada and Mexico that allows USMCA compliant goods to travel tariff free, when does that expire? Is it on 7/9/25?
Yeah.
Retaliatory tariffs? Okay.
It is.
Okay,
and we never know if it's going to be re-upped. That's a really hard question to say when is expiring, but yes. I mean,
as of
auto
right
parts
now.
are separate. The auto parts is 5.3, but the rest is 7.9.
Okay, great. And then will the tariff assessed on Mexican imported goods be on the entire product value if not USMCA compliant, or just the portion of the product's value that's not sourced from the US?
Not sure exactly.
Yeah, I'm
I
not sure.
understand that question. It depends on what you're doing with that product. So for example, if it was being returned to the United States, it would only be the percentage, the US content could be ruled out. I'm not sure. I can't see
Mhm.
all of these fast enough. There's like quite a few
Yeah,
of these. So,
there are
I
some
mean,
great
I'm happy
questions.
to answer some of these separately. That one was more, what about the US content that was in USMCA? So in order to qualify for USMCA, it has to be US origin, Canadian origin, or Mexican origin. So you really need to first qualify there to get the USMCA rates. But if that good was for some reason subject also to duties from China because you had stuff going in, yes, they would exempt the part that was you know, USMCA/US, but it's pretty detailed to have to look at it and overlap it far more than I could answer today going in it.
Right, and Jennifer does have her contact info up there, so you can follow up. And then I'd let everybody know too that the World Trade Center plans to have a webinar on USMCA, so you may learn more about that in that webinar. And I wanted to know too about when you had mentioned there might be some conflicts between USMCA origin regulations versus origin tests versus 301s. What does one do in that case? When you've got the
When they're
contradiction.
inconsistent,
Mhm.
yeah, well, so let's use USMCA because I have a client that just went through this, where you may qualify for USMCA. So let's say the base import duty into the United States is 5%. Okay, so if you qualify for USMCA, you don't have to pay that 5% at all. So you're moving it across the border duty free. But if at the same time it's not substantially transformed under 301 or IIEPA or any of those, then you won't owe the 5%, but you might owe the 125, 155 on China. So instead of owing 160, you owe 155.
Okay.
That's the difference. But I think a lot of people have assumed if it's Mexican origin, then it's not Chinese origin.
Yeah. Okay. Thanks. Um, the next one was, I'm not sure I quite understand this. What specific laws preclude a supplier from an across-the-board surcharge?
I understand what they're asking because
Okay,
I
good.
brought that up. So
Okay.
there are certain state laws. It doesn't necessarily preclude you from doing a surcharge, but it's got specific disclosure requirements. So you can't just make up a surcharge and say my surcharge is 100% because it cost me so much. That surcharge has to be directly related to the tariff amount. And states are starting to pass this really as a consumer protection area as opposed to, because anyone can say I'm marking something up because there's a tariff, but they may not even be having anything to do with tariffs.
Yeah.
So you've got to
Okay.
show and again, these are new laws. So, and there are new legislation in place. So knowing what to show is actually, I don't know the answer to all of that right now, but you'd have to
Yeah.
show a correlation.
Got it. Next question was, how and when would we be assessed a tariff? Like, when does that actually hit you? And then there was a corollary question regarding if we paid for DDP, what does that mean? Tariff charges will be covered by the broker seller and not, not us.
Okay,
I
I'll
think
answer
those can
the
be
first one.
combined.
When does a tariff become due? It becomes due when you enter the customs territory, when you file your formal entry, you have a bond, a customs bond that you've posted that says that bond's out there with a surety to cover the tariffs that I do, that I owe. Customs is in the process of assessing those tariffs, and when your goods are finally liquidated, which is usually 314 days after entry, that is when the final tariff becomes due, regardless of, what you may have paid. So they've assessed it and then it becomes due. So the assessment happens when it enters the country, but they might be looking at other things. Liquidation might be delayed because of anti-dumping duties or because you might be using a different valuation method. But once it's liquidated, that's when the duties are finally owed. If you got a penalty, it's when they give you a penalty notice on it. The second part of that question, I'm trying to remember, was about
If you paid DDP, does that mean tariff charges will be covered by the broker or seller?
yes, DDP is delivered duty paid, which means the seller is responsible for clearing customs in the United States and bringing it to your final place. That was the issue that I brought up and said, yeah, that's the case. They're including that in the price, presumably. They may be messing with value in order to get that done, but as long as that's not under your importer of record number, that's their separate importer of record number, they're responsible for what they do. But if they use your importer of record number and clear at DDP, you're liable if they don't get any of this right. And so that's a big risk area that I've seen recently.
Yeah, because I think a lot of people are in the situation where I believe this person is in the situation where the contract was agreed to before all the tariffs came into play. So, if the shipper or the seller is in deep doo-doo because of it, are they still on the hook? Is there anything that?
Only if they're the importer of record or they somehow participated in the fraud. They could have some real liabilities if they have a discussion and say, we're going to say this is less, or,
So you can't agree to a different price after the fact.
you can if it's a fair price between unrelated parties, but you can't agree to a price that says you're going to invoice me one price and we're going to clear it under customs for another, or we're going to say this is from Malaysia when it's from China, or those kind of things.
Yeah, great, thank you. This is, I think, a simple one. A Section 232, does it apply to ag machinery parts from Canada? Maybe it's not so simple. Depends.
Yes, 232 applies to the whole world, but there are some exemptions under USMCA depending on the origin of what those are. And there are some exemptions for part of that if it falls under.
Okay, great. Okay, so this one
I
is.
have a very intricate map that I've drawn out where you're like, if I go to here and then I go to there and then it has this, it's these overlapping ones that are really challenging. But usually 232 overrides many of the other duties, but not necessarily the 20%. It's the addition. So, we've got 155. If it's China, we got 155. We have the 10 and 10, which became the 20 for fentanyl. That stays. It's only the 125 that you're allowed to counter against with 232. And Canada's separate, I know, but I mean, by the time we map these all out, it's quite an elaborate thing.
Yeah, and it sounds like you're rolling right into the next question regarding the Annex 2 exemption for reciprocal tariffs. If my goods are exempt per this list, do I still pay 10 plus 10 on the IEEPA tariffs on top of the regular tariff rate?
Yeah,
No.
Annex 2 of Executive Order 2 is what I think they're talking about, the exemption on the 125. You still play 10 and 10. I think what they're discussing, but
great. Okay, and so that's all.
I often need my map to look at.
Yeah. So now we have 9 other questions that have gone into the open Q&A part since since we started going here. And just so everybody knows, in case I had created this webinar to run until 11:15, so I don't know what will happen if we go over it. So if it stops for some reason, we'll continue to try to get to these questions in when we send out the follow-up slides to people. Jennifer, are you looking in the open Q&A? And then a couple people had put questions in the chat.
There's so many scrolling down.
Yeah, we had requested people not put questions in the chat, but some of you may have come in late and missed that. So we will try to get to the chat, but first we're going to go through the open questions in the Q&A. So If a manufacturing company temporarily exported components to Mexico for a few years and didn't have any modifications, tries to bring them back into the US, under subheading 9801, would they have to pay taxes or duties on the components? Or how would that be
9801
done?
and 9801 functions somewhat very similarly to 9802. So yeah, that you have an exemption under 9801.
Okay, so that's good.
Again, that's if we're in a purely Mexico US scenario. I don't know what's happening if parts are coming in from another country.
Yeah, very important. How would you have US content with IEEPA? Does this mean you purchase something and transform it in the US before selling?
Okay, so they're asking a question. The IEEPA, the second one that's the 125, and the reciprocal tariffs and global tariffs of 10%. That's what that the exemptions on that second one, not the first two, 10 and 10. So it is a substantial or wholly produced. So any item that's wholly produced in the United States, and there's tests about like it's grown here. I milk. I've milked the cow.
Okay.
Down the
Yep.
crops, that's one thing. That's probably if you're, or you could have a wholly produced, like everything you've done here is a produced versus assembled. There are a lot of intricate tests on this. So substantial transformation test comes into play to say it's US content if it's not otherwise sourced or made in the US. We look at if you're suddenly dealing with a product that's got all kinds of different things going in from all different countries, they look at, was the product changed? Was there a change in name, character, and use? And was there enough change in it that the item that now imparts the essential character of it is in fact the new item? And again, it depends on what it is. Like, for example, I took fabric and I cut it and I sewed it into a suit in the United States. Yeah, the suit is now the item, but is the essential character the wool? If it's a wool suit, is it the fabric? It's things we're looking at. The suit's a completely different item. I couldn't wear the fabric. But if I brought in a toolbox, for example, or I was exporting toolboxes, I brought in the box and the tools and I just stuck the tools in the box. No, it's now a toolbox, and before it was a box without tools in it. Seems very different to me, but customs does not think it's different. Just the manner of sticking the tools in the box is not enough. So there are a million different outcomes, and you can go to customs and you can get your own ruling on what this is.
Great. Do machined aluminum parts imported from China fall under Section 232?
Machined aluminum parts. Well, it depends if they'd be considered a derivative on one of the derivative lists on chapter, I think it's 73 or 76. It depends if they'd be one of the underlying steel, like sheet, if they're just sheet. I don't know what this part is,
Yeah.
just simply if it's extruded aluminum, it may be subject to anti-dumping duties, for example, too, in addition to this. So you have to specifically look at the product being on these lists in the annex. And even if your product, like for example, I have a client who makes auto parts, but they're not for passenger vehicles, but they are under the HTS code that falls. They're the specific, because gears just fall under gears or something like that. And it's not different regardless of whether it's in a light vehicle or a light passenger vehicle or it's in your golf cart. But for that example, it would be different because there's a code that you can enter it in a 90C saying it's 9903 saying it is not a passenger vehicle. So if it's not always the HTS code that's dispositive, it's sometimes the description in the order too, because HTS codes might sweep in a lot more, but it's the description of what they mean. So it's hard to answer machine very generally.
Yeah.
Yeah.
Yeah, I think there's going to be a number of these that we'll have to just follow up with Jennifer on. One of my questions, though, regarding that is, are some of these questions answerable by one's broker, freight forwarder?
Some are, and they'll tell you where they can't answer it
Yeah.
or you need additional help, but you have to be hiring your broker to do this. You can't assume they're doing it for you. They have
Mhm.
a SOP, a standard operating procedure, or a POA, and that POA absolves them if they've misclassified or done anything because they're relying on you. So you have to make that relationship clear that they are giving you specific advice on this.
Yeah. Great. Okay. And then the next one, we're getting parts from Canada duty free, but because they are steel parts, we're getting hit with 25% under derivative. But I don't see a question here. We are importing a machine from Sweden. Those are two different questions. Don't know if you want to try to ask for more detail on that. I think what we probably need to do is skip ahead, only in the interest of time.
Yeah, I mean,
Sorry, sorry,
I
Nelson.
don't know, you know,
Yeah.
yeah, I'm not sure what the question is.
And then he's got another question right after that. So maybe you can answer that one. We're importing a machine from Sweden that was hit with 10% tariffs. It's also mostly steel. Would Section 232 also apply? Do you also need to ask additional questions, Jennifer, to answer that?
Yeah, I mean, some of these
Okay.
are, I'm not gonna be able to in the time or in the ability
Yeah.
to like really answer specific questions that would require me to look at the HTS code, see
Yeah.
what's classified, see what's covered. I haven't memorized all of the annexes
You
and what's
haven't?
covered.
All right. Well, moving along here. Thank you for being. I mean, just amazes me how much you know and can answer these. So the next one here, our freight forwarder and the bonded warehouse that they recommended say that the tariff charge will be upon removal from the warehouse. This was what you mentioned early on about FTZs, or but they're using a bonded warehouse. Um, it sounded like you were saying the only option is upon entry only. She had
Well,
also put this
FTZs
in
have
the.
it's not been clear to me entirely on bonded warehouses, whether or not those enter a bonded warehouse under special privilege status. Because, but I tend to think if they're doing that to an FTZ, there may be some rules around bonded warehouse. I was gonna look at this further because the executive orders don't specifically reference a bonded warehouse. They reference, as far as and I, again, not reading every detail of everyone, they do specifically call out an FTZ. So the bonded warehouse is, you usually can't use these as you could in the past to avoid the duties. People were asking me questions about what happens if the duties change while I'm in this one place, like it's in a deferral mechanism, what happens? And so I said, there's going to be a difference. If the laws were to get repealed, for example, meaning the ones that are tracking up through the court right now, which I think that actually there are not grounds for implementing under IEEPA, but I don't know. A lot of trade lawyers have discussed this and we don't believe there's legal grounds, but we'll have to see what the courts do. But if it were to be overturned, then the duties going back to the beginning of time would be overturned. You know, the beginning of when they were implemented. So they would never be there in the first place. So that's a very different answer than these duties are changing. So it's like for 10 days they were this, for another 20 days they were this. You're actually paying the different duty amounts during each of those times. So I'm just kind of laying like a basis of all this. So you might owe from April or from February 3rd to or February 20th to March 6th, you might owe 10%. From March 6th to April 10th, you might
Oh,
owe
wow.
20%. And you literally have to, you know, and custom system isn't ready to keep up with all of
Yeah.
these amounts. And so, you know, I steered a little away from the bonded ware, but I think it's important to understand that there's all these different duty rates and it would be whatever the rate is typically at the time it entered the trade zone, but may potentially also be the same because you couldn't avoid all of it. I don't know about a special bonded warehouse that would be any
Mhm.
different than any other bonded warehouse. But that's not been clear with bonded warehouses, in at least in
Well,
my
I
opinion.
I appreciate these additional questions. We are going to touch on those in the foreign trade zone webinar, but I think we're going to have to give I'm going to have to give the speakers special heads up that these are the kinds of, I mean, they probably know already. They're probably getting these same questions. But Terry, we'll make sure that you know about that FTZ webinar when it gets posted, which will be soon.
I know the answer for FTZs for sure. I just
Okay.
funded
Yeah.
warehouses.
Yeah. Okay, and then this may be another one, but we'll try to ask it, but it may be another one that is too much detail to be answered here on the spot. But a supplier of precision tools partner with a manufacturer in Spain that drop ships the products to customers. Can you read it? Using the commercial invoice with my price to the customer, can they ship with Incoterms DDP and we add the total value to the invoice with D&T included? Are you able to see that?
I'm not sure what that means. I'm
Yeah,
a
I think
partner and that they drop ship the products to I create commercial invoice with my
so.
price.
I know
I mean,
this.
I can tell you big picture.
Yeah.
That if these are unrelated parties, that value must reflect the actual customs value. You can't take out different parts of those things. If they're selling it to you, DDP, and then you're paying them and you're paying them separately outside of what's being declared to customs, that's not okay. It's whatever you are actually the price payable or paid to, and that doesn't mean just in the one invoice. That means the total price that you're paying them for everything they're doing to supply that good.
Okay, and then he's got a follow-on question, which I'll just read it. When goods are being delivered to a freight forwarder in the US, but being moved to a final destination, South America, is US Customs charging duties and taxes? I think
I didn't see that one.
because it's right after that one, because they're being manufactured in Spain. I believe these are the same items being manufactured in Spain, shipped to the US with ultimate destination of South America.
So it comes to the US and then it's exported back out.
Yeah, that's what it sounds like.
You may be able to participate. You may be able to put it in a bonded warehouse, send it out, never pay duties. You may be able to participate in drawback. Because if it leaves the country, there's always different, or if it's a temporary import without doing further manufacturing and sending it out you may be able to have a different deferral program on that. Not sure what the question is, but
yeah, I think that's close enough. And I know that questioner, so we can follow up with him later. Okay, and then Nelson, who asked the questions before, has put a little bit more detail in there, but I'm afraid, folks, that we're pretty low on time. So I think we'll also follow up with you and with you, Nelson, and try to see if we can get that answered separately. And we still have, gosh, almost 40 people still on the chat. So thank you, Jennifer, for answering all these questions. I'm double checking. I said still on the chat. I mean, still on the webinar, because I'm checking the chat to make sure that we have covered, I believe we covered most of this. These have been retyped into the Q&A.
yeah, I mean, some of these are a little too specific where I won't cross the border to I'm not giving legal advice. I'll say that,
yes,
I'm
right.
generally answering some questions.
Yeah.
Nothing what I say, is looking at every specific situation. I don't know enough about the situation to be able to give really specific legal advice.
Yeah, it's important that we make sure everybody's clear on that this is not,
I'm not asking you, you're not my client, I'm not relying, I'm just talking
right.
some general
Yeah.
things. Yeah.
Yeah.
I don't know enough detail in this to be able to.
Right. And I think there's just one last question that is in the webinar chat. So, and this may fall into that same category where you're not able to answer it right now, but wafers produced in the US and shipped to Vietnam for assembly and test and is now becomes a semiconductor, will a tariff be applied to the value add completed in Vietnam or the total value, including the value from the US?
I feel like this could be my client because but that is a pretty detailed question. It's so it's shipped to Vietnam for assembly and then it's being tested in the US. I don't know if there's what further manufacture is happening in the United States. It might be able to enter under TIB, temporary import under bond, if it's just a test. But if you're doing certain Manufacturing, you may not be able to do it, but they're also asking if the value add complete in Vietnam or the US, yes, you could exclude if you were re-importing it. I mean, because the tariff is if you were importing something into the United States from another country that had US content on it, you could, and Vietnam's only subject to a 10% right now. And so the question is this US or is it Vietnam? So we have to do an origin test to figure out which it is. But from, you know, assuming it's from Vietnam, we're only at 10%, although Vietnam is one of the one that was targeted, I don't know, somewhere in the 30s. I can't remember the exact on a reciprocal tariff. But you were looking at the total value, but if the portion of it that was done in the US, if you can show that and you can show substantial transformation for that portion, you could potentially exclude that from the 10% IEEPA global tariff that applies.
Wow. Okay, well, I am making sure right now that I've copied all of the questions in the Q&A so that we have captured them, because I think the webinar will do that, but I'm not 100% sure. So I've copied those. So we will include some of that in the follow-up when we send out the slides and Jennifer's recording. So I thank everyone very much for the interest, and I certainly, my heart goes out to all of you that are dealing with this. I know it's challenging, and I know Jennifer hasn't been getting too much sleep lately.
My sympathies, it is not clear. It is happening very fast, and it is changing daily, and it is a lot. And I think now is a time to look at all your customs processes again and make sure that they are right, because the impact here is just so much heavier. And then do you have legitimate savings opportunities here?
Yeah. Well, thank you as always. Lindsay, would you like to wrap us up, take us out of here, and we will send the follow-up soon.
Yes, thanks again, everyone, for joining us, and thank you so much to our speaker, Jennifer. At the conclusion of this webinar, a survey will appear in your browser. We'd really appreciate your feedback on this presentation, your thoughts, and your thoughts on future topics that you'd like to learn just a little bit more about. But thank you all again, and have a great day.
Thank you.